married to a Ghanaian, the belief being that, okay, the children that is going to get, they will give birth to, assuming that there is children that came out of the marriage, will be Ghanaian citizens, isn't it? Okay. And they will benefit from that business. Okay. Aha. Even with ownership of assets in Ghana, when a foreigner owns an asset in Ghana, after 50 years, okay, that ownership of asset does not belong to him. It turns over to the rightful owners again. So when you see people renting their houses to foreigners, the reason why they are doing that is that after 50 years, the law says that you don't own, that foreigner doesn't own that land. It goes back to the what? To the Ghanaian. Do you get the point? Hello? So you see a Chinese married a Ghanaian. You see Nigerian married a Ghanaian and he's operating a business. Nobody goes to attack that person. Do you get it? Hi, who asked that question? Was it Mark or Kennedy?
Yes, Mark.
Mark, okay. Please, I hope it's clear.
Yes, sir. Thank you.
So, with the issue of the GIPC issue that happened, well, I'm looking at, well, they will bring some 10% or 5% for that area. Okay, because that issue trended for like a whole month. Okay, and then now there is a new commissioner general. Do you get it? Yes, but maybe it may not come. It may come in the form of you addressing the issue or telling them the tax implication why foreigners have to. And then it can also, this question can also be linked up to the 24-hour economy. Okay, this area can also be linked up to 24-hour economy. That government is looking at intensifying the 24-hour economy. Investors have decided to come to Ghana to invest into certain priority areas, like renewable energy and other things. Advise them about the tax implication, or advise them about the laws that govern a foreigner, okay, investing in Ghana. Then you are supposed to take advantage and then note your points and then write them clearly. I hope that is clear. Hello?
Hi, so we are here.
Yeah.
So, Mark, let's go to the next question.
All right. Required. You have been invited as a final candidate to advise the company.
Read the preamble.
All right. Okay. Nana Limited is a Japan company and has a subsidiary in Ghana by the name Nana Ghana Limited. The parent company in 2008 gave a loan facility to the subsidiary to support its operations. However, interest on the loan from 2009 to 2019 came to 8 million after applying a thin capitalization rule in taxation. As a result, the total amount was accrued by Nana Ghana Limited. As the company did not have money to pay the interest as agreed in the loan contract, the total amount of the loan was 20 million. In the year 2020, the board took a decision to relieve the subsidiary of the loan obligation, meaning the loan with its interest was not going to be repaid by the subsidiary. Required, you have been invited as a final level candidate to advise the company on the tax implication of this arrangement.
So without going to the answer, okay?
Okay.
Now, with our knowledge on the capitalization that we did, what do you think? What are the issues related to the preamble? Let's identify them. Yes. When you identify the issues, okay? When you identify the issues, answering it becomes very simple. What is the focus area of the preamble? Hello?
The thin capitalization.
Thin capitalization. Good. And another thin capitalization, we said, what does the rule says?
So the safe harbor rule is you can borrow 3 times equity.
3 times of your equity. Okay.
Yes,
You can borrow
please.
up to a maximum of 3 times of your equity. If you exceed
Yes.
the maximum of your 3 times of your equity, what does the law says? So you do not to say it as that alone. Add to the conclusion that where it says the 3 times the equity, okay, the excess amount, the interest on the excess amount, okay, it is not the excess amount that is disallowed. Please note, it is not the excess amount that is disallowed. It is the interest computation on the excess amount that is disallowed. Please, is it clear?
Yeah.
Yes, sir.
Good. So if you are talking about think capitalization, we need to talk about safe harbor rule. Add, say it up to the end. Don't just say that when the debt to equity ratio is supposed to be 3:1. So the equity, if the equity is 1, the debt must be 3 times the equity and you end it there. No, that is the general rule. However, what does the law say? The law says that if it meets that threshold, okay, then it's a safe. But when it is allowable, but if it is exceed that threshold of 3:1, the interest on the excess loan is disallowed. But if it meets the ratio of 3:1, the interest on the loan is an allowable deduction, which means it meets the conditions. Okay?
Yeah.
Please, I hope it's clear.
Yeah.
All right. Mark.
Yes, sir. All right. The loan from the parent company to a subsidiary shall be subject to the thin capitalization rule. The interest on the loan is tax deductible, provided it is within the thin capitalization rule. With the accumulated interest of 8 million and a loan amount of 20 million forgiven by the parent company, both become income in the books of Nana Ghana Limited and therefore taxable. Tax implication. Please, should I continue?
It's tax implication. Continue, yes.
So please, I should continue.
Yeah, continue the tax implication.
All right. So tax implication. The withholding tax on the amount of interest on the loan shall be deducted and paid to the Ghana Revenue Authority in line with the tax provision. Additionally, the amount of $800,000 forgiven in the loan of $20 million shall be treated as income in the company's book for tax purposes.
All right. So now, when under think capitalization too, we say that there are certain conditions that must be met. Okay, that will make the company. We say that it meets the think capitalization rule. 1, we say that the loan must be coming from where? A related party. Okay.
Yes.
2, the related party can be what? Either resident or what? Non-resident. Please, are you there?
Yes.
Good. So there are things that you need to check whether the loan was coming from a related party. If the loan is not coming from a related party, it doesn't fall under think capitalization. I hope you get it. Hello.
Aye.
Good. So get to know that. So in this case, you realize that it was a subsidiary. Okay. Now, you have been given a loan, and at a point in time, your parent company waived the loan. Okay. That loan becomes what? It turns to what? What will you classify it as? Hello? Hey, you are not speaking. Okay, you want me to do all the talking. I want to find out whether you can recall all what you have learned. You see, you have given a loan. Your parent company has given you a loan. Okay? And at a particular point, that loan, if they didn't charge you an interest on it, then that is interest-free. But if they charge you an interest on it, and at the end, they said they have waived it. So if they said they have waived it, you are benefiting from the loan and then the interest. Is that not it?
Yes.
Okay.
That's the case.
Good. So that loan can be converted into what? equity. You
Okay.
can't say it's a gift. Can you say it's a gift? Eh? My people, will you classify it as a gift? No, it's not a gift, okay? So it will be treated as an equity. But in this case, looking at the question, it turned out to be what? An additional fund. And then as a result of that, it's an income that they are receiving. And that income will be added back to their what? That loan will be added back to their income. Okay, their chargeable income. And will be taxed according to the graduated tax rate. Please, is it clear to you? Hello?
Yes, sir.
All right. So the income treatment of the tax treatment, the income tax treatment, is when you add it back. The issue is that one, the dividend will go through its rule, okay? And then the dividend, we know that it is subject to 8% what? Withholding tax. Okay, and that is what? Final.
Yeah.
I hope that is clear. Eh?
Yes, sir.
Okay. Yesterday we spoke about a closed company. Mark, read the last word on that day. Where a company.
Where a company which is controlled by not more than 5 persons and their associates do not distribute to its shareholders as dividends a reasonable part of the income of the company. Let me take it again. Where a company which is controlled by not more than 5 persons and their associates do not distribute to its shareholders as dividends a reasonable part of the income of the company, the Commissioner General may treat any part of the company's profit as dividend after considering the current business requirement of the company and any other requirements necessary for the maintenance and development of the business.
All right. So you realize that in that situation, this is how they will treat it. Now let's come to, yes, the income tax treatment, providing the loan, if they provide the loan. If it was a loan.
The income tax treatment of providing the asset to the company as a loan. The issues to be addressed are: one, the returns on a loan or debt obligations are interest. Interest paid on debt obligations which is employed in the business or used to purchase an asset which is employed in the business is generally deductible for tax purposes, thereby reducing the chargeable income on which tax is imposed. Interest on debt paid to an individual other than interest paid by a resident financial institution is subject to a withholding tax of 1%.
So there is a difference between a loan given by a resident company and then a loan given by what? An individual. For a resident company, the interest that is accrued, for a resident company, the interest is subject to 8% what? Withholding tax rate.
Withholding.
Or if it's an individual that is giving the loan to the business, okay, the withholding tax is 1%. Please get to know this difference. It is very important. Okay. You come across questions that are framed, and then you see that there is an individual giving a facility to the other. All right.
So,
Yes.
what if it is not a resident financial institution? If it's a non-resident financial institution?
Yes, but if it is a non-resident financial institution, okay, and it's a parent or it's a parent company, and then they are related. Do you get it?
Yes,
It
sir.
will still go the way.
Okay, okay.
That is why when
Thank
we were
you.
looking at decapitalization, we say that there are 3 conditions that must be met. Even though loan is given, okay, the loan must come from what? A related party. 1, okay. The related party, okay, must own a certain share percentage. That shows that. Good. 2, 3, the related party can be either a resident or a non-resident entity. Do you get it?
Yes, sir.
Okay. All right. There was this question, but I felt okay. Let's go. Let's go through this. The differentiate between yes.
Okay. So, difference between tax evasion and tax avoidance. Tax
And let
avoidance.
but you go ahead.
Okay. Tax avoidance is synonymous to tax planning in the sense that it also takes advantage of the provision of the tax laws to pay the minimum tax. Secondly, it does not involve itself in anything illegal. Tax avoidance schemes operate by finding loopholes in the tax laws and using them to pay the minimum of tax or not paying anything at all. It therefore requires a comprehensive knowledge of the tax laws to determine what exemptions, reliefs, and other incentives are available to take advantage of them.
So we
Tax
spoke about this
okay.
yesterday, and we look at
Yes.
the avoidance strategy. All right, go ahead with the tax evasion.
Tax evasion. Tax evasion, unlike tax avoidance, is illegal. It involves a deliberate act of 1. Failure to declare and under declarations, submitting false statements and returns, overstating expense and cost, keeping one set of books containing false entries for the tax authorities, and another set of books with the correct business operations for himself, and any other fraudulent act or means of deliberately dodging or minimizing payment tax on one's income. It is a crime against the state, and therefore any person who aids or abates is also guilty and punishable under the tax laws.
All right. This area
Where
took.
the tax
Go ahead. Go ahead.
where the taxable person does not possess a tax invoice, under what circumstances would the Commissioner General allow? Okay, I think this one is a question, so
Okay.
or I should continue.
Yeah. It's okay. You should leave
Okay,
it. I mean, what I share with you.
where
So,
the okay,
so what happens is that this area can also be framed for you to maybe educate some people or educate a group of market women or educate some group of people who have started who are in Ghana or a church, okay, or a group and they are asking you to I mean there is a talk and you have been asked to make a paper presentation, okay, on tax evasion, okay, with giving a correlative example and how its impact on the business profitability and the business sustainability, okay. So in that aspect, you define them, and then you talk about the mode under which the methods under which tax evasion can appear as well as tax avoidance. Okay. All right. So tax evasion can also be using barter system. Barter is also one. All right. Because for instance, if Mark has a cattle farm, okay, and then his cattle farm is located at Yechi, and then who will I use? Kennedy. Kennedy is into IT system. Okay, it's into security system. So it provides security cameras, wire fencing. And Mark requested that Mark requested that I need a security system. Want to fence his cattle farm so that it can have a CCTV camera mounted on the cattle farm so that it can be in Accra and be able to monitor how the cattle are moving. Okay. Why did Mark decide to do that? Because he realized that the herdsman over there has been saying that every week 5 cattle has been every week they lost 5 cattle as a result of some diseases. Some of the Newcastle diseases, those we read in our Greek. So Mark decided that okay, Kennedy, come and provide this security system for me. And Kennedy did that. And Kennedy remembered that, oh, okay, my nephew or my niece, and then my sister will be marrying next month. So she will also need some 3 cattle, or my brother will be marrying next month, so we will need some 3 cattle. Or I want to do my birthday party, another thing. So instead of you paying me the money, giving me cattle in exchange. Have you seen it? So by so doing, they have what? They have evaded tax through barter trade. Please, I hope you can hear me.
Yes, sir.
Yes. So they have evaded tax through barter trade. But so nobody will get to know. Okay. All right. And that barter trade can serve as both tax evasion as well as what? Tax avoidance strategy. Okay. All right. Let's go ahead. Oh, this question. All right. Let's see whether we will be able to answer it. Mark, read this one.
All right. The following is the extracts of records of Pajero Limited for 2020 year of assessment. Written down value, sorry. Yes, written down value, 20,000. Purchase of additional computer, 120,000. Additional information, Pajero Limited spent an amount of 30,000 on an upgrade of some computers of Pajero Limited. Its basis period is January to December each year. Required, determine the capital allowance for 2020 year of assessment. B, the amount to be capitalized, and C, the amount to be expensed.
All right, my people, this one, we have to answer it. We solved something yesterday. Yes, who starts? Who said the ball rolling? I want to display the solution. Let's do it. Let me see whether yesterday you people just came to the class, enjoyed the class, and went to sleep. Let me see. Prove me wrong. Yes, who said the ball rolling? Hey. Hello.
Hi.
Are you poor?
Hi.
You have observed. Abba.
We are here.
Yes, set the ball rolling. Answer the question. Yesterday we treated this. We treated deep and went even mixture. So yes, let me hear. Yes, who is starting?
Sir, I want to ask a question.
Hello.
Go ahead. Go ahead.
Hello.
Yes.
Hello.
Hello, go ahead.
Oh, okay.
No. Sunday, wait. Somebody wants to ask a question. Please go ahead and ask your
Okay.
question.
So
problem.
the written down value CD 2019. What was the CD 2019? What I'm trying to understand. If I
Please,
get
your
that, I
voice,
can
your
check.
voice is low. I can't hear you.
That's carry down, carry down. That's carry down.
No. Yes, I understand the carry down. The CD 2019. Is it what is that? That's what I'm not able
it's
to
carry down. It's
figure out.
carry down.
Carry down. Oh, okay. Carry down 2019. Okay. Okay.
Were you
Sorry.
an accounting student?
No, I'm not an accounting student. Along the line, I joined. So the way you put it, I got a bit confused, but I get it now.
In accounting, we say there are 3 rules. Rule number 1 says that debit the receiver, credit the giver. Rule number 2 says that for every debit entry, there must be a corresponding credit entry. And rule number 3 says that for every credit balance, there must be a corresponding debit balance. Okay?
Yeah. No, I understand it. The way you put it, the way you did the C/D, and I saw that way, I got a bit confused, but I get it. Yes, I understand.
All right. Yes, let's go ahead. Yes. Who is solving the question? Somebody should lead. Hey, we did this yesterday. Yeah, don't disgrace me.
Wait, I'm coming. I beg you. I'm learning. I'm learning.
Who is taking the lead? Hey, are you off your rules?
Yeah, hello.
Yes.
So from my point, first you write the name of the company, which is Pajero Limited. I hope you can hear me.
Yeah, we can hear you. Go ahead.
Then you indicate the year of assessment, which is 2020.
You write the title. What are you computing? Please.
Sorry. Then the title, competition of capital allowance.
Okay.
Then the year of assessment, 2020. Then basis period.
The year of assessment is what?
General.
The year of assessment is what?
Hello.
Yes.
I said January, first January to 31st
I
December.
said the year of assessment. You said year of assessment. Which year?
2020.
What's the year of assessment?
That's which year?
2020.
2020. 2020.
You see how confused you are? It's 2020. We said 2019. I heard 2019. That's why I was asking.
No, no, no. I didn't
Oh,
say.
you
I
said
didn't mention
2020.
2019. I said 2020.
All right,
Hey,
go ahead.
master. Then the basis period, that's 1st January to 31st December.
All right.
Then I'll now bring my pool. So I'll bring my pool one. That's pool one. Pool one.
Pool one, yes.
So then I'll bring the written down value, which is 20,000.
Yes.
Then there was an addition.
Good.
Then there was an addition. Then I'll add addition. Meanwhile, I have to put the capital allowance rate, which is a 40% reducing balance.
Okay.
So when I get the total, then I can now compute the capital
The total
allowance.
be what?
But before,
The total is
sorry,
20,000 plus. And
yeah, that would be 100. That would be
what will be the total?
140,000. 140,000.
Okay, go ahead. Yes.
Uh-huh.
Okay. So
Then
that
I will
becomes
now
the
compute my
depreciation.
yes. The depreciable base. Then I will now compute the capital allowance. Then after that, then they have given. They said there was an upgrade.
How do you calculate your capital allowance? Hey. How do you calculate
That's
your capital
40%.
allowance? Let us know.
40% of the depreciable base, which is 140.
By how many? A times B times C. You have mentioned the A, you have mentioned
Yes.
the B. What's the C?
Okay. The C is the basis period, which is 365.
Okay. Because
Mm-hmm.
the basis period started from January, each calendar year. Okay, go ahead.
But along the line, we're told that there was an upgrade on the computer, which is and they spent 30,000. So I have to calculate my. I have to confirm that figure. So I mean, I have to calculate my what do you call it? The actual improvement figure. So I mean, I'll calculate the 5% on the written down value and compare with what has been given to find out whether they are together or it has confirmed with that figure or it hasn't. Hello?
Yeah, go ahead. We are listening.
So if the figure that I had gotten from the written down figure is lower than what is given, meaning the excess one will be disallowed. It means I have to capitalize it and then charge capital loss.
Okay. So the excess one will be capitalized, and then which one will be expensed?
The expense one will be the allowable one.
The allowable one. That's the 5% of the written down value.
The 5%. Yes.
It's not 5% of the 30. You find 5% of the written down value
Of the written down value.
Of the pool that it belongs to. Okay? 5% of the written down value of the pool. And you compare that 5% of the written down value with the amount spent, the 30,000. Okay? So if 5% of the full pool end up, which means it is exceeds the 30,000. Okay? So the 10,000, if 5% is 40,000, it doesn't exceed it. So that one, you grant it fully. But if the 5% of the pool, 5% of the pool, okay, is less than the amount spent. That is where if 5% of the pool, let's assume that 5% of the pool is 10,000. Okay. You compare the 10,000 to the 30,000. So you realize that there is an 10,000, there is an excess of 20,000. So that 20,000 will be what? Disallowed. And any amount that is disallowed is capital. Okay. So by so doing, you add it back to the pool again and then prepare its capital allowance. I hope you remember yesterday we went through that. Is it clear?
Yes, sir.
All right.
Yes.
So the solution is this. So we realized that we had the 140. Then you calculate the capital allowance on it. That gives us 56, and then we less it. We get the written down value to be 84. Okay, and then we find 5% of the 84,000. That is the 4,200. We compare the 4,200 with the 30,000. Okay, we realize that it exceeds the 5% is less. So that 5%, which is the 4,200, is the amount to be expensed, and it is the allowable what? It is the allowable written repairs and maintenance. Okay, the allowable repairs and maintenance is the same amount to be expensed, and then there is allowable is 25,800. Okay, and that is what to be capitalized. And by so doing, you have to come and start it and then add it back into the what? To the pool. By adding it back to the pool, what it means is that we will have the 20,000 written down value from 2019, add addition of 120, and then add the repairs and improvements that is capitalized of 25,800 to it. And that give you 145,800. You add it back to the written down value of 20,000, and that give you 165,800. Then we calculate the capital allowance on the straight line method, on the reducing balance method. Okay. All right. And that will be the 40% because the asset is computer and it belongs to pool one. All right. I hope that is clear. Hello.
Very well.
All right. Let's look at this area which will form exchange of assets. My reader, Mark. Who?
Yes, sir. All right. Capital allowance, exchange of assets. Sakote Limited, a trading company, has the following extras from its financial records. It bought a 4x4 vehicle for an amount of 225,000 in the year 2015. The cost of the vehicle was limited to an amount of 75,000 for capital allowance purposes in year 2015. It also put up a building at a cost of 150,000 in the same year. The cost of the land was 20,000 and Ghana cedi 130,000 was the cost of the building. The company accordingly informed the Commissioner General about putting the assets into use and in the generation of its income in 2015 year of assessment. In the year 2016, it exchanged the vehicle for 4 plots of land. The value of the plot of land agreed with the landowners was 220,000. The exchange was deemed satisfactory to both parties and documentations were carried through. Required. Calculate the amount of capital allowance claimable for 2016 year of assessment by Sakote Limited. Sakote Limited paid for goodwill amounting to 10,000 in 2016 and intends to grant capital allowance on the value of the goodwill. Explain whether or not this arrangement is in accordance with the tax laws.
My people, are you there? Those of you who are not talking, I'll mention your name right now. Start talking before I mention your name. Yesterday, you were not part. You didn't introduce yourself. You ran away. Yes. You see how a capital allowance question comes also? Hello? Can I be heard?
Yes, sir, you can be heard.
Yes.
Pepe, are you online? Ikea, I finished it, isn't it? Don't hide. Oh. All right, let's take it one after the other. They bought 4x4 vehicle. Okay. What is the amount?
225,000.
Hello? In 2015, they bought 4x4 vehicle. What is the amount?
225,000.
225,000. All right. That vehicle, where does it fall? Which pool?
Pool 2.
2.
Pool 2.
Yes.
All right. And Pool 2, what is the please when you say Pool 2, add the rate and everything. I don't want you to say Pool 2 and then
30% reducing balance.
say that again.
30% reducing balance.
30% reducing balance. All right. There's somebody should read the second one.
It also put up a building at a cost of 150,000 cedis in the same year. The cost of the land was 20,000 cedis.
He put up
and
a
130.
building at a cost of 150,000.
Yes.
But the
In
building,
the same
when
year.
you look at that question, they break it down for us, isn't it?
Yeah.
What is the cost of the land?
20,000.
20,000.
And then the cost of the building?
130,000.
Hello?
130,000.
130,000. Hey.
The cost of the building?
We can hear you. It's from your end.
We can hear Paul. Hello, sir. I think it's off now.
I'm sure the network.
I'm having a
That's
problem with my
disappointing.
system.
Hello, can you see my screen?
You're welcome back.
Yes, not knowing I was talking, not knowing I'm muted. Sorry. All right.
Oh, it's your network, not that you were muted.
No, my network went, it came back. Okay, and I joined again. But I realized that when I joined, my microphone was muted and I was talking. So we realized that the land is 20,000 and then the building is what? 130. Yesterday we saw in a scenario case where the two assets has their lump sum, they didn't break them down for us. But this one they have break them down. So the land, which pool does it belong to?
Pool 4.
It's not a depreciable.
It's not part. It's
The land is not a
part.
depreciable asset.
It's not a
You only
depreciable
deal with the
asset.
building.
Oh, you see, when you get to realization of assets, that is where people will get. But the building is what?
It's a depreciable one, so you can.
So the land, what will you classify it? Is it?
So I think
it's a fall
we'll not
under.
classify, just leave it and then work with the building.
And that is where you find under realization, when you do realization of an asset, okay? All right. So we will know the pool that now the exchange. I want us to take the exchange. Mark, read the exchange again.
Oh, sir, he's not online now, so let me continue.
It's not
Okay.
on.
He's doing something outside there. He'll soon join us. Sir, so from which point?
In the year 2016, start from the year 2016 to the requirement again.
Okay, sir. And the okay, so Mark is here, so let him man.
Yeah, start from in the year 2016.
He says,
All right. So in the year 2016, it exchanged the vehicle of in the year 2016, it exchanged the vehicle for 4 plots of land. The value of the plots of land agreed with the land owners was 220,000. The exchange was deemed satisfactory to both parties and documentations were carried through.
Okay.
Required. Calculate. Okay.
Requirement, yes.
So calculate the amount of capital allowance claimable for 2016 year of assessment by Sakote Limited. Sakote Limited paid for goodwill amounting to 10,000 in 2016 and intends to grant capital allowance on the value of the goodwill. Explain whether or not this arrangement is in accordance with the tax laws.
Are you done?
Yes, please, sir.
All right. So let's go through the requirement, the solutions. Okay. So the year, like Sandy said, you present it this way with the years, okay? And then you bring the heading, the computation. Oh, it Saturday computation. So class 2, and then there was a class 4. That is the what? The building. So the class 2 was the 4x4, which is 225, but I have to restrict it the cost to what? 75,000. Okay. And then we bring that of the what? The land. Okay. Now the capital allowance, you calculate the 30% on it, and this for the class 4 is 10% straight line, so 10% on the cost. Then you get a written down value. Now you add the total capital allowance. That's a 22 plus the 13,000. That will give you the 35,500. Okay. So when you have the written down value, you come over to the class. There was an exchange. It was a class 4 asset, isn't it? So when you come over, okay, to the next year, the written down value was 117, and then this was 52,500. Okay. So the written down value, we have to bring them 52,500, 117. Okay. Now there was a proceed. There was a change. Okay. So he exchanged the vehicle for a land. I hope you get that. And then what was the amount? The amount was what? 220,000 cedis. So that's the proceed from the sale. Okay. So let's see from it. That gives you a nil effect. And then the capital allowance for the depreciation base will still be 117. You still calculate its capital allowance because this one, because it is the proceed was higher than the written down value, it will be nil. It's a negative figure. And by so doing, they said when it's less than the cost value, you grant the same thing to bring the capital allowance. You grant the same capital allowance to bring the written down value to nil. All right. I hope that is clear. Hello.
Hi. Yes, sir.
Good. So the analysis for that is that the 167 constitute income, okay, which should be added to the what? The business income, okay. And if it has to add it to the business income, the section 5, okay, section 5 of the Income Tax Act talks about the business income, and section 6 talks about the investment income. Okay, so you have to be added to the business income under the section 5 of the at 896. And then the capital allowance of 30,000 is claimable, okay, because that is the year that it was, because the previous year it becomes an unrelieved one, which you can be carried forward. Now, in the case of the goodwill that they said they paid for the goodwill, we say that the goodwill do qualify for capital expenditure, okay, it's occurred under the act, okay. Good. And we say that the capital allowance is not granted in respect of assets such as an asset which is not what, a depreciable asset. Okay. Good. But in accordance with section 133 of the Act, it defines what a goodwill means. Okay. And goodwill will not qualify for what? Will not be granted what? A capital allowance. Hello.
We are with you.
All right.
Hi.
So let's look at a partnership question here. My guy, read for me.
Yes, sir. Aba and Ba are partners sharing profits and losses in the ratio 2:3 in a law firm for some time now. The following relates to 2020 year of assessment. Profit before appropriation, 2 million. The following were deducted in arriving at the profit before appropriation: depreciation, refreshment, computer acquired, salary partner, Aba, interest on loan to partner, Aba, Ba. The following relates to the partner's circumstances. 1. Marriage. Aba is married while Ba is not married. Children in primary school. Aba has one in primary school in Ghana, while Ba has 2 children also in primary school in Ghana. Required. Compute the taxable income to be subject to tax.
All right, let's discuss this.
Right.
What is the ratio of their capital contribution?
2:3.
So the total ratio will be what?
5.
5. All right.
5.
Good. Now, in preparation of partnership account, these are individual partners. So they will be subject to the graduated tax rate.
Tax rate.
But if they are law firms, 2 law firms that have come to partner, okay, to win a business, okay, to go on to represent a country or to represent a client in another country or even in Ghana, in that aspect, they will be subject to the corporate tax rate of 25 because they are companies, okay. But a partnership and an individual partnership, they will go through the graduated tax rate. Now, when you look at it, they said their profit before appropriation was what?
2 million.
2 million.
So let's look at, and they said the following were deducted in arriving at the what? The profit before appropriation. Depreciation. Is it allowable?
No, we add back.
No. That's bad.
Refreshment.
We add back.
We add back.
Computer acquired.
We add back.
Capital allowance.
It's capital allowance. We'll
So what
capitalize
do
it.
you do?
It's capital,
We
we'll
add back.
capitalize it and grant capital allowance.
We add back.
Capitalize
We
it
add
because
back.
it's of the capital
We
nature.
add back.
So
We
you
add
add
back.
it back. Good. Please, don't just be saying the add back. Sometimes they can give you a question like that, and they can put it there that explain the treatment. You said it should be added back. Why should it be added? You must explain the treatment why it should be added back. Okay. For depreciation, we know that. What's the reason behind depreciation? Why you add back? Yes. Why do we add depreciation back? Those of you who say add back. Yes. You know add back, but you don't know the reason behind the add back.
Depreciation
Oh,
is
no.
not allowed in taxation.
Depreciation
Instead,
is what?
the capital allowance is granted
That's
in
all
place.
this allowed.
Hey, I want to hear it again. Speak the English. Can't meeting. Speak your English, yes, go ahead. You see, she's afraid. When I say
Depreciation, hello. Depreciation is an expense, and then it decreased in the value of the capital asset. So therefore, once it is on a capital asset, it should be capitalized. It should be capitalized and grant capital allowance.
Master, you are far behind, okay, for what you are saying. How do you say by depreciation is a capital asset?
No, I said depreciation is an expense on a depreciable asset. Hello. And when it happened, it decreased the value.
Did you get the question?
It decreased the value.
That's why are we deducting depreciation? Because in taxation, depreciation is not allowed. It's rather capital allowance that is granted.
Why?
Sure.
Yes, go ahead.
Yes, sir. So like my sister said, in taxation, depreciation is not allowed because companies may use different rate or different percentages in calculating depreciation. So because of that, we use a capital allowance instead of depreciation.
Sorry, I clap for you. You have answered it perfectly. They are all going somewhere. Depreciation is what? It's a policy. It is not supported by any law. Please.
Wow.
So it differs from one company to the other. When you go to company A, the same motor vehicle, they are using 20%. Another company is using 35%. It's based on company's policy. Do you get it? But when it comes to taxation, it's based on the law. Hello? That's why you can find the capital allowance on a schedule in a law, in the Income Act 896. Please. Yeah? So don't say accounting, taxation, the depreciation is disallowed. Please don't say that. Is that clear to you?
Yes, sir.
You are writing something in English. And then this is when you go, you say that I don't understand. You understand as you are going ahead. Like yesterday, where some people decide to review their marks. All right. So we say computer is of a capital nature. Okay, capital asset acquisition of capital nature. And however, it should be granted capital allowance. So it should be disallowed. So all these figures has been taken away from it. All right. Salary partner, Baba, how will you treat it? Interest on loan to partner, Aba, how will you treat them? Hey, so if partnership question come like this small question, you are all silent. Then if it's loaded,
So you add it back.
you add it back to what?
That's why he doesn't want to
You
hear.
add it back to the profit before appropriation.
Profit before appropriation. Okay, that's the partners. Is it profit? You said you add back to profit before appropriation. Please your name. Please your name.
Yeah, he has no name.
Yeah, me. I will check. Sister, what's the papa? We don't add it to profit before appropriation, please. That goes to the partner's account. Okay.
No, sir, please. I thought it will be added after the profit is shared, after the adjusted profit is shared, before you add it back to their individual shared profits.
Yes. So
that is why I said you add it back to the profit before
why are we
appropriation.
adding back? Why are you adding back?
Partners are not entitled to individual income from the business, so you have to add it back. Then later, when the profit is shared based on their ratio, you now add it back to individual
Into their capital,
profit.
into their
Then you
individual
start it
capital.
individually. Please.
Idioma. What's your name?
Equia.
Hey, Ekia. But you look like you have a Nigerian tone. Well, let me reserve that for myself. Have you finished eating?
Yes.
All right, Ekia.
So please, what I say, is it correct? So that if it's not correct, I
Yes.
will take it from my mind and take the correct one from you.
No. You see, you answer the question partially. Do you get it? So you do the first treatment and then there was the second treatment. I've been telling you when
Okay.
you answer the question, answer it fully. You see, some people, when I said depreciation, somebody said, yes, it's an accounting, you're not supposed to, but they didn't say the rationale behind.
Okay. Okay.
So that you have to do the two treatments. Do you get it?
Okay, sir.
That's why I intentionally asked you, why do you add it back? And you have explained the rationale behind it. Do you get it?
Okay, sir.
Right.
Thank
There
you.
is this aspect which I think, okay, let's come to the marriage. The marriage and the children. Abba is married, whilst Baba is not married. Now, let's look at the children. Children in primary school. Abba has one in a primary school in Ghana, whilst Ba has two children also in primary school in Ghana. What do you think these two information gives out? To the partners.
So,
Reliefs.
so Abba will be entitled to dependency relief and then child education relief, while Ba will be entitled for only child education relief since she's not married.
Yes, please. Your first one that you said dependent is out. It's not correct. Yes, any other person? Please analyze it and tell me. Those of you are hiding. I'll mention your name.
Hello, sir.
Yes, go ahead.
Abba is married, so he will enjoy a marriage. A marriage, yeah, starts responsibility with the amount of 1,300, and Ba also has two children, so Ba will also enjoy 600 cedis per child in the school.
Hmm. Hmm.
And but
Hello.
so since Ba has two children, he will also enjoy a marriage responsibility. Marriage responsibility.
What are you mixing together? You are on the right path, but you are mixing two things.
But say, Ban is not married, so he's only
Hello.
entitled to responsibility relief.
Hello.
Who said Ba is not married? He's entitled to responsibility.
Say I did.
Hello.
You who?
Me, Gladys.
Gladys.
Yes, sir.
And then what else will he get? Will she get?
Then Ban will, apart from receiving the responsibility relief, he is also entitled to the children education for two children, 600 per child.
And what about Abba?
Abba is going to receive a marriage relief of 1,200 and then children education for one child, 600 per the child.
What does the law say for children education? It said to a maximum of what?
Of 3.
Okay.
Three.
Okay. So you are right, Gladys. So under the first thing, Abba is entitled to marriage, and Ba is also entitled to responsibility relief. That's why the relief we said marriage or responsibility is 1,200.
Oh, okay.
Okay. So if you are not married and you have two children, you enjoy responsibility relief. That's what the law says. If you are married, if you are not married and you have one child, you don't get responsibility
You
relief.
don't qualify. Okay.
Thank you. Do you get it? So if it is, and the law didn't say that if you are not married and you have side chick, you have children with 2 side chicks, you don't qualify.
This man.
Why? I'm making the explanation clear to you so that you can easily remember.
I will remember, Pa.
The one who said this man, tell him he's the one who has done, he has a responsibility with leave. Okay, so that's what the law says. Okay. So you see, if Ba happen to enjoy more than, will enjoy more than what? Abba, because at least he has 2 children. So the education relief will get 2. Whereas Abba will only get 1. I hope that is clear.
I really know times.
I realize this confused people and they were finding it difficult to come and talk. All right. Gladys, thank you for saving your people. You are the Moses of the
They
Israel.
are welcome.
They are welcome, eh? So we'll get to you. All right. Okay, so we are going to the computation, ABA and BA, computation appropriation for 2020 year of assessment. We bring the basis period, you bring your city currency sign, so profit before appropriation, okay? That will be on the far right. I wanted to. Me, John, can't be much of a fan. Yeah. So let me see. Okay. Oh, why is it that my classroom? What's happening? Okay, let me reduce it here. Hey. Let me get the mouse. Oh, nothing big. Just give me some minutes. Let me use my mouse. Yeah. Let's a minute. It's just I don't know why. Hey, who is playing something at the background? Oh. All right. Let me go and lower it. This week, last week. All right. I hope you can see this one. Maybe this is a bit of it. Also. All right, let's go ahead. So you see the profit before appropriation is 200,000. You add back the non-allowable deductions, okay? Which is the depreciation, refreshment, the computer that was purchased was of a capital nature. The salary as Gladys spoke, and then the interest, okay? That was paid, interest on the loan that was paid, you add back to get the correct appropriation, okay? Then we grant the capital allowance on the computer, that is the 110,000. That will fall under class 1, and that's 40% on the 110, that's 44,000. You less it from to get the profit for appropriation, okay? Then we do the share of the what? Their profit. The ratio was 2:3, so total ratio is 5. So 2/5 times the profit for appropriations. And that is what you're going to use in their computation of their taxable income. So over here, you come with a share of the appropriation for each of them, Aba and Ba. So you create the heading Aba Ba, the show appropriation, and then the salary, and then the interest for each of them. That will give you the amount. Then the less relief. Okay. The relief, we spoke about marriage and responsibility. They will enjoy this. Aba will enjoy marriage, whilst Ba enjoy responsibility relief. When it comes to the child education, we said Aba will enjoy only 600. Then Ba, because he has 6 times 2, that was 1,002. So that will be the total relief. We less it from the total appropriation amount to get this is the taxable income. So this income is the amount that will be taxed based on the graduated tax rate. Please, is that clear? Hello, is it clear?
Yes, sir.
Yes, sir.
Marco, let's go to this one. I don't want to.
All right, sir. Kweku Luke, a 28-year-old entrepreneur, having heard about the 24-hour economy, where restaurants and chop bars, will need meat for their sumptuous fufu and palm nut soup for their clients. Kweku Luke intends to establish a grass cutter business. He was not sure if there are incentives available for him. Please, I take it again. He was not sure if there are incentives available to him if he goes on large-scale production of the meat, and what are the tax implications on the grass cutter business in Ghana. Required, as a final level student of ICA with knowledge in advanced taxation, enumerate the incentives and tax implication of a grass cutter business in Ghana to me.
Please, I hope you heard your question. Hello? My people, are you there?
Yes,
Very well.
please.
We are
Yeah.
here.
Okay, let's answer the question.
So if I'm going to tackle this question, since Kwekuluk is of the age of 28, I will call him a young entrepreneur.
Okay.
And, a young entrepreneur who is going into grass cutter production. So he will enjoy that young entrepreneur tax incentives. Where if, assuming he decide to establish in the greater Accra and Tema region, he will pay a rate of 15%. But if he decide to go outside Greater Accra to any other region aside the Northern Savannah Ecological Zone, 12.5 rate will be applied. Then any other town aside the regional capitals will be 10, and then 5% to the Northern Savannah Ecological Zone. And he can also decide, he can also enjoy the location incentives.
Okay. That's good. That's a good one. Young entrepreneur, you said Accra Tema is what rate? What rate did you mention?
It's 20.
Please, it's not 20.
It's 20, not 15.
It's 15. Who said 20? Who said 20 is not 15?
So
Who is
it's
that?
15, it's 15, not 20. I mentioned 15.
You mentioned 15. Okay, you are
Yes.
right. You are correct. All right. Let's go ahead. So, in tackling this question, Mark, can you read for me?
All right, sir. Grass cutter business falls under livestock farming, and livestock farming enjoys temporary concession of 5 years. And during the 5 years period, pay tax at a rate of 5% on chargeable income as a sole proprietor. After the first 5 years of operation, Kweku Luke can take advantage of the locational incentive to locate a business outside Accra and Tema area. He can enjoy the benefit under a young entrepreneur under the age of 35 years, engage in livestock farming.
Hold on. So
Okay.
if first he has to first enjoy, okay, the temporary concession, okay, for doing the grass cutter business. What do you call grass cutter in tree? That's a crantier.
Sorry.
I can't hear. I can't hear.
The guy said cry. Yeah. It's a crantier. Okay. So you can first, and because it's into a grass cutter business, that's a livestock farming. So after enjoying the 5 years, already his age is 28. 28 plus 5 will be what? Hello?
33.
So
33.
So first, you have to enjoy this 5 years concessional period. Do you get it? So after enjoying that 5 years concessional period, that is what, in this case, we are using what? Tax avoidance strategy. Do you get it? Eh? Because if you use only the young entrepreneur, you have left the livestock farming, which there is a temporary concession. Do you get it? So he has to enjoy that one. And by that 5 years, he's 33. And that 33, he still fall under the what? A young entrepreneur, under the age of what? 35. And because he engaged in the livestock, he will attract the following what? Rates. I hope that is clear to you. And also, he can also carry over his losses for the next 5 years. And then, if Kuku decide to employ fresh graduates, okay, who has finished national service, it also attracts less tax payment, okay, based upon the workforce that he used. Please, is that clear to you?
Very well.
All right. So the tax implication on Kukulu's grass cutter business. 1. Kukulu will pay income tax at a rate of 5% on his chargeable income during the concessionary period. Okay. If he's providing the services to restaurants and chop bars, as the question said, Kukulu will charge what? A rate of what? 3%. Hey, who is that ruling? Who is that? Christy? Christy, be careful. Yes, Christy. Christy, I'm listening to you. Where is that Christy? Who is Christy? Hello?
Christy is Christy. She's hiding somewhere.
Christy, be careful, Attention. Okay, you can charge VAT at a rate of 3%. Okay, flat rate, and the flat rate goes with a copy of 1% on all the sales to the restaurant. Okay, because he's providing goods. Don't go and charge 5% because he's providing works. Please, they are goods. And then he's supposed also to withhold taxes on payment to employees if he's working with people. Okay, under Section 114 of the Income Tax Act. Okay. Now, it's also supposed to withhold at a rate of 5% final on gross income, okay, for engaging any casual workers. If you engage casual workers who have to go and then catch the grass cutter for you, in seasoning, as and when you need them, you have to charge 5% on their gross income. And then it's also supposed to withhold 7.5% from services that he renders to business, okay, services that they render to the business, the grass cutter business, by, let's say, veterinary doctors on their livestock. You know, in Ghana, if you have to kill the goats, the butchers, you know, they send it to the veterinary for them to examine and confirm before they kill, they slaughter it and bring it to the slaughterhouse. the ladies among us, when you go to the market, you go to the abattoir, don't you see there are stamps on some of the goods when they hang them?
No.
Yes,
You don't watch.
yes.
You're only interested in the meat. So they have to send you to veterinary to confirm that the goat is alive, is good, it is not suffering from any disease. Okay, it is good. It is good for human consumption before they slaughter it. That is why when you buy from any kwanche, you eat and you realize that Charlie, you are vomiting. So when you buy for the abattoir and the prices, they sell it by the kilo price, please. They go through this. All right. And then he is supposed to ensure that by the 15th of the following month, on the same month, he remits that money to the Ghana Revenue Authority. Is that clear? All right, let's come to fiscal policy. Yes, this one I will just brush through. Read the question. I'll not answer. We will not go through the answers. We will just. Yes, Mark.
Taxation has been described as the socio-economic bedrock of nation. State and explain 5 reasons in support of this statement. Socio-economic significance of taxation. Tax revenue may be used to meet government expenditure such as development of infrastructure, payment of employees' remuneration, etc. Taxation may be used as a tool for equitable distribution of income. Though the institution of progressive system of taxation, the rich are made to contribute more to the taxation fund than the poor, and thus bridging the gap of inequality between the two. Taxation may be used as a tool to faster growth. Is it tool or tool? Anyway, taxation may be used as a tool to faster growth of the key sectors of the economy. This is done by giving tax concessions like reduction in tax rates, tax holidays as motivation for would-be investors. Taxation may be used as a tool to minimize budgetary deficit or fiscal gap. An efficient and effective.
Hold on. You know that by November they will read the budget. So please expect question from fiscal policy. All right, go ahead. Mark, go ahead.
Yes, sir. An efficient and effective tax administration may result in increase in tax revenue, which may have the effect of narrowing the budgetary deficit, resulting in reduced government borrowing. Taxation may be used as a tool to control the level of inflation or deflation. As a spiraling inflationary situation may be controlled by increasing the incidence of taxation, while a deflationary situation may be curbed by reducing the incidence of taxation.
Right.
Discrimination duties also. Okay.
Discrimination.
All right. Discrimination duties or super boxes may be used to discourage the importation of certain goods, either to conserve foreign exchange or protect local industries.
Yes. In the other way around, this year, how has government used? There has been a new policy that the government used to control fiscal policy in Ghana. Government
reduction in interest rates.
Reduction in what?
Interest rates.
Fine, but there was something. Government used that as a resource to curb the foreign exchange exposure. And that was a fiscal policy intervention. What was that? Okay, let me give you a clue. Mama, I've given you a clue.
By establishing the gold board.
Thank you. Thank you. Thank you. By establishing the gold board. Okay. And that way around, government had a central unit where all minerals, okay, were purchased by the government, and the government rather deal on that behalf. And that government used the good board to be able to stabilize the what? The inflation, and it uses as a what? A fiscal policy measures, as well as a monetary policy measures. Okay. And by so doing, government was also able to, when he buys it from the people, individuals can no longer carry good outside and go and sell to others. They have to sell to the good board, and the good board rather trade. By so doing, government have excess money, government buy from the people, and government is able to trade on behalf of the people and get the excess money to be able to do developmental projects, as well as to be able to stabilize the economy, to be able to stabilize the foreign exchange movement. All right. Please, you know this is current, isn't it? Hello?
Aye.
No. Be there like this thing and be doing, hi. All right. My reader, let's go to this one.
Yes,
This
sir.
one,
Discuss 5 ways by which.
just read the heading. Don't talk about it. We'll move to the next.
All right.
I think
Discuss 5 ways by which tax justice system can address the problem of inequality in an economy.
Okay, that's okay. So please go and answer your question. Let's go to the next one. This one we will discuss it. Details. Yes.
With reference to the Income Tax Regulation 2016 LI 224, outline the income tax treatment for the lessor and lessee under finance lease.
I hope you know IFRS 16.
Yes, sir.
It's on what topic? What?
IFRS 16.
Hey! IFRS 16.
No, sir. You were saying that IFRS 16.
I was
I'm
asking
only
you
repeating.
it's on which topic? Eh? These questions have been asked in interview.
This one is under ISAS 24 also.
You see the burger man. When I'm talking about IFRS, he's telling me IPSAS. When I'm asking IFRS 16, he's telling me IPSAS. Hey, IFRS 16, please. You remember right of use assets?
Yes, sir.
Yes.
Hey! And remember this liability?
Yes, sir.
IFRS 16 is leasehold. Please. Question can be asked on that. Because a lot of people have leased properties in Ghana. They don't owe them. And there are tax implications relating to lease. All right. Mark, read. Treatment in respect of the lessor. Who is the lessor?
Income tax treatment.
Hold on. Who is the lessor and who is the lessor?
Lessor is the one leasing the asset to the lessee, the original owner. Let me put it that way.
The landlord. Okay, the original owner. And who is the lessor? Wait, who is the lessee?
Tenant.
The new owner.
Okay. Mark, go ahead.
Treatment in respect of lessor. In ascertaining the income for a year of assessment, that lessor shall include the whole of the amount of the interest and repayment of the capital for that year as income in respect of the leased asset. Is not entitled to capital allowance in respect of the leased asset, may reduce the amount of repayment of capital included in income by a capital amount deemed by the Commissioner General.
Okay. So what happens is that, you see, you are the lessor, you are the rightful owner, but now because you have leased your asset to the lessee now has the right of use of the asset. So he will claim the lessee will claim capital allowance. But you have what? Part way with ownership. Do you get it? As a result of the lease. Eh? Hello?
Yes, sir.
That's why I say that it's not entitled to capital allowance in respect of the what? The lease asset. Because he has part way with the ownership. Now, the one who has ownership for a period is the lessee. And that lessee will record in his book as right of use asset. He can't record in his book as a property. Do you get it? So if your company has acquired has leased a place and they are working over there and your factory is there, you don't own it. Always your balance sheet should show right of use asset. I hope that is clear. Let's go ahead. Treatment in respect of lessee.
So treatment in respect of the lessee. In ascertaining the income for a year of assessment, the lessee shall deduct the interest portion for each year of assessment as an expense from income. Treat the repayment of capital as a repayment under a loan agreement and shall deduct the repayment from the income. Be entitled to capital allowance in respect of the capital portion. In respect of the lease of a road vehicle, other than the commercial vehicle, the capital portion shall not exceed 75,000 as required by the third schedule of Act 896.
I hope you have seen it. The 75,000. We are asking the Commissioner General to review it because now the cost of vehicle are becoming very high. Now 75,000. Well, maybe you get Toyota Bit. You get Toyota Bit. So we are hoping they will do that in their next budget. All right, let's go ahead. Read this question.
Where a resident person enters into a contract with a non-resident person under Section 116, subsection 10 of Act 896, what requirements needs to be satisfied by the resident person?
Yes, my people, what requirements? Who is a resident person? Under Section 101, subsection 1 of Act 896. Who is a resident person? Hey, you won't talk. I'll mention names, eh? Gladys.
Permanent place of abode in Ghana.
Permanent place of abode. You haven't said anything. It's partial. IKEA.
Lives in Ghana 183 days.
Individual or an establishment.
Whether it's an individual or an establishment. Let me focus on individual before coming to establishment. Hey, and what's okay, let's go.
Individual, someone who has been in Ghana for more than 185 days.
Hey, please be very careful. Be very, very careful. IKEA.
Yes, sir.
Now, Section 101, subsection 1. It talks about a resident person. You see that a citizen, okay, an individual who has lived in the country, who has a permanent home outside Ghana, okay, and live in that place for a continuous period of 365 days. That is Section 101, subsection 1A. Subsection 1B talks about a non-resident person who triggers a residence in Ghana. Okay, so that is where it says that a resident person is a person who's lived in the country for a period of 183 days. Please, it is for a non-resident person that trigger residence. It's not for a resident person.
Okay.
Get the difference. So that Indian person that is working in your factory or working in your company, and they say he's a consultant, immediately it gets to 6 months. It's no more supposed to be treated as a contract staff. Otherwise, when GRA comes for tax audit, you'll be surcharged a lot and you'll suffer. After the 6 months, he triggers what? A resident, and he must be taxed on the graduated tax rate. Please, is that clear to you? And then section 101, subsection 1C talks about an individual that has been posted by the what? The government of Ghana outside the country. For instance, the consulates, the ambassadors, the Ministry of Foreign Affairs. You see Ghana Embassy in UK. Those people, they fall under section 101, subsection 1C. And they stay in that country for the period of 365 days. They pay their tax to Ghana because Ghana tax the worldwide income. And then the D also talks about the same resident person who temporarily has left the country but has a permanent home in Ghana. Yo, I finished. Mark, read the solution. Let's go.
All right. The resident person is required within 30 days of entering the contract to give notice to the CJ, Commissioner General. Say your screen is off.
Hey, wait, Banison, please give me a minute.
Okay, sir.
What happened? Oh, this is my mouse. Give me a minute, please. Oh. Christy and Co. You are the people disturbing my mouse, eh? This one. This is important. Ah. I think the mouse is not. Ah. Let me go with my. Hey. All right, please give me a minute. Where's my? Oh, you know what? Really sunny for me. Oh. Please, what do you say? Ah. Okay. Please, I'll join you soon, right now. All right. Mark. Yeah, Mark. Can you see my
Hello,
screen?
sir.
Can you see my screen?
Yes, sir. It's uploading.
Okay. So let's go ahead.
Okay. The resident person is required within 30 days of entering the contract to give notice to the CJ in writing of the following information. A, the nature of the contract. B, the likely duration of the contract. C, the name and postal address of the non-resident person to whom payments under the contract are to be made, and the total sum estimated to be payable under the contract to the non-resident person.
Okay. So that is for that. Okay. Let's go
Yes, sir.
to the next question.
Identify and analyze the two types of double taxation and explain any way that double taxation can occur. Are there means to relieve international double taxation?
All right. So what are the two means of double taxation? I should have covered.
Juridical and economic.
Okay. What is the juridical? How do you explain that one?
So juridical is taxing the same income of a taxpayer in two different states.
Okay. Where one country claims what? Residence status.
Yes,
Residence
please.
status. Okay. Then
Yes,
the other
sir.
country claim residence status. So Ghana, a non-resident become a resident when that non-resident stayed in Ghana for a period of aggregated period of what? 183 days or 6
183 days.
okay, in a physical year. So when you say aggregated period, whether he comes, he goes and comes, he goes and comes, when the calculating is the number of days that he has been in the country, add up to 183 days, then he has triggered residence. Okay. So Ghana will tax it because and use the calculated tax rate because he has triggered residence. In South Africa, you trigger residence when you stay there for 3 months. That's 90 days. Okay. So if you stayed here 6 months and you go to South Africa and stay there, that is what is going to cause what you call double taxation issue. But Ghana has DTA with South Africa. Mention the countries that Ghana has DTA with.
UK,
Mauritius,
Switzerland,
Morocco,
Morocco.
Germany, Switzerland,
UK,
England.
Switzerland, Qatar.
Czech Republic.
Who said Qatar?
Maybe it's in the pipeline.
It's not.
Oh, I like is
The
a
question is
recent
that-
one. Oh, I like is
The
a
question is
recent
that-
one. Oh.
The question is that why is it that Ghana is not having DTA with its neighbored country? Why? Why do you think so? Ghana is surrounded on the east by. Hey, Ghana is surrounded on the east by.
Cote d'Ivoire.
Togo.
Hey, Lutu.
Hmm.
On the east by Togo. On the west.
Cote d'Ivoire.
On the north.
Burkina Faso.
Burkina.
On the south.
Gulf of Guinea.
United Ocean.
Gulf of
Hey,
Guinea.
Gulf of Guinea. Yeah. So the question is that why is that Ghana don't have DTA with our neighboring country? Have you thought of that? All right, let's go ahead. Mark, read economical double taxation.
Okay, sir. Economic double taxation, where an amount of income is taxed twice, either within a jurisdiction or across jurisdictions. Corporate income is subjected to CIT, and the after-tax profit declared as dividend is subject to dividend tax. Employment tax and after-tax employment are subject to federal taxes when the employee expends the money. Example, when the employee uses the money to pay for goods or a housemaid.
Okay. So if you decide they pay you your salary, the salary already suffered PAYE, and you decide to walk to Melcom or walk to the mall, when you buy, you pay consumption tax, isn't it? Whatever
Yes, sir.
from Melcom, you pay VAT, you pay the COVID, and that is rated by the Melcom people on behalf of GRA. All right, let's go to juridical double taxation. Read that one.
So where more than one country attempts to tax the same income. Otherwise, a person's income, property, or capital is taxed more than twice due to the location of that person.
Sure. He stays
Juridical.
here 6 months and then he moved to South Africa, stay there for another 3 months. Okay. All right. Ways, causes of double taxation. Yes. Let's go.
All right. Causes of double taxation. Juridical double taxation normally occurs as a result of the conflict between two tax systems. 1. Resident system conflicts with source system. Under the resident principle, residents of the country are taxed on their worldwide income. And under the source principle, under the source principle, non-residents are taxed on their domestic source income only. Suppose a person is a resident of Ghana with business or investment activities in India. He will be liable to pay tax on the income arising from the activity in India under the source principle. And in Ghana, under the resident principle, one country assesses the right to tax foreign source income of a taxpayer because the taxpayer is a resident of that country. One country assesses the right to tax foreign source income of a taxpayer because the taxpayer is a resident of that country, and other country assets the right to tax the same income because the income arises or has its source in that country.
Okay, so an Indian decided to come to Ghana to work as an expatriate. With Indian, their law says that you can't naturalize. If you naturalize, you have to disown your family. So he becomes a resident over there. But he comes to Ghana to work over here. So he will be taxed. And that is what we call resident system conflict with what? Source system. The source system, because once he's working in Ghana, okay, his source of the income that he's getting is derived from Ghana. It's accrued in Ghana. I hope you get that. Hello? Well, I guess everybody is sleeping. So when you get to 9 o'clock, I will close.
Please take it again.
I should take what again?
The last statement you just made, the explanation.
Oh, okay. The last statement you just made. Is it okay? Is that you?
Yes.
Hey, after you have eaten, you have gotten energy. You're asking me plenty questions. Yeah. I will answer, okay? All right. So what I'm saying is that an Indian, okay, or a Chinese is a resident of his country, okay? And the Chinese or the Indian comes to work in Ghana. Either is working as a chef in a restaurant or working with the construction company that is into the road construction, okay? Immediately he comes here and he works here. The income that he earns here is subject to tax because it is called the source system. The income accrued or derived, whether it's a business income, employment income, or investment income, is subject to tax. That is why we say that because though he's a non-resident, because his source is income over here, he'll be taxed. But a resident system, because he's a resident of that country, he has been there for long, he was born, bred, and bred over there. That is where it's also subject to tax over there. So that's a double taxation conflict. But where Ghana has DTA with those countries, we look at the double taxation agreement. Okay, so the double taxation, for instance, if the person is here and is supposed to pay withholding, the withholding tax of 25%, because there's a DTA between Ghana and that country, they may agree on that when it happens, instead of charging the withholding of maybe 20%, okay, they will charge him the withholding of maybe 10% because of the DTA. That is the essence of the DTA. And then the DTA also give powers to the country to exchange informations. Okay. Now, the other country can ask Ghana, provide me list of all Indians that are in Ghana, that are working and earning income in Ghana. An Indian will tax because if they are taxing worldwide income, if they are also using the worldwide income taxation, they will tax both your global income and your foreign income, and then your local income as well. Please, is that clear to you?
Yes, sir.
Yes, sir.
My guy, go ahead. Yeah, about 9 o'clock. I will finish. Oh, okay, I will do 9:30.
All right, sir. Resident system conflict with resident system. This is where two countries claim that a particular taxpayer is a resident of their tax jurisdiction. At the same time, it is now the international norm for countries to spend the whole year outside Ghana.
You have jumped.
Hey, I've jumped, yes. It is now the international norm for countries to tax residents on worldwide income. Okay.
Yeah.
In Ghana, an individual is a resident if that individual is a citizen and does not spend the whole year outside Ghana, goes to South Africa, spends 90 days, and becomes a resident in South Africa. Ghana taxes worldwide and South African worldwide. Two countries assert the right to tax the same income of a taxpayer because they both claim that the taxpayer is a resident of their country, that is dual resident taxpayer.
So I hope it's self-explanatory.
Oh. Yes, sir.
Go ahead. Next
source system conflicts with source system. The conflict arises when more than one country claims that revenue was sourced from its territory. Countries regard interests as sourced from their jurisdiction if the security used to secure the interest in the country's jurisdiction, and at the same time, when the resident person pays the interest. Two countries assert the right to tax the same income of the taxpayer because they both claim that the income is sourced in their country.
All right. Wow. So Mark has a business in Dubai. Okay. Mark is a citizen of Ghana, but has a business in Dubai. Mark went to Dubai and he realized that Dubai Bank is giving loans to businesses at a rate of 1.5% per annum. Mark applied for the loan of $50 million. Now, the loan that Mark used to secure the collateral that Mark used to secure that loan is located in Ghana, and it is worth $20 million US. So in that place, that is called source system conflict with source system. You are deriving the loan or accruing the income, okay, the benefits in our country in Dubai. So we will tax it. Because you are taking the loan, we will tax it. Now, Ghana will also say that, yes, though you are sourcing from that country, the collateral that you are using to secure the loan is located in what? In Ghana. So we will also tax that interest. That's a source system conflict with source system. Another scenario. For the full year, you work 6 months here, and then you went to South Africa and also went for 4 months there. So they will tax using the source system because South Africa, 90 days, you trigger residence. Do you get it? Hello? And moreover, because you went to South Africa, you work, the income you earned from your employment was sourced because as a result of you coming to South Africa, that's where you earn that income. Otherwise, you won't get it. All right, let's go ahead. Double taxation relief. Please, any question? Hello?
Hi,
yes, sir.
Okay.
We are with you.
All right, let's go. Mark.
We are enjoying the flow. Yes, sir. Double taxation reliefs. Tax credit reliefs, tax exemption reliefs, and then tax deduction reliefs. The credit system gives credit for foreign income tax paid against the home country tax liability on that income. Under the credit method, resident taxpayers are treated equally. The foreign tax paid is used as a credit against domestic liability, irrespective of the foreign tax rate. This form of credit relief limits the tax paid on the foreign source of the domestic tax rate, to the domestic tax rate. Please, I take it again. This form of credit relief limits the tax paid on the foreign source to the domestic tax rate. For example, if the foreign tax rate is 35% and the domestic tax rate is 30%, if the foreign tax rate is 35 and the domestic tax rate is 30%, foreign tax will be limited to 30% tax rate. Ghana uses ordinary credit relief.
Mhm.
Section 112, subsection 1, provides a resident person, other than a partnership, may claim taxes on foreign income earned, but the amount of the foreign income tax rate shall not exceed the average rate of Ghanaian tax. ARGT.
Average rate of Ghanaian tax.
Okay, average rate of Ghanaian tax is the total tax charge divided by the chargeable income. So
Okay.
the tax charge, that is a formula. Average
All right.
rate of Ghanaian tax is tax charge.
All
Okay,
right.
chargeable
So,
income.
for credit relief, Ghana, we only practice the ordinary credit relief. We have the full method, okay, and we have the ordinary credit method. There are three, okay. But Ghana, we practice the ordinary credit relief. The full credit relief says that when you pay a foreign tax of 35% in UK. When you come to Ghana, they grant you the full amount. Exactly. Now, currently, what is the tax bracket for an individual? The highest is what, 35, isn't it? Hey, do you mean you don't know your PAYE table?
So yes, 35.
Yes, the highest is 35. Those of you who don't do.
35.
So if you go to, if like you travel to UK and then all your total tax is around 45% of your income. When you come to Ghana, because our domestic tax rate, the highest is 35%. Because you have incurred 45%, Ghana will grant you only 35%. The 10 will not be granted, will be disallowed. Okay. And there's a formula for doing that. This is not the day to calculate that. If you join my class, you would have known it. So let's go with it. Let's leave the double taxation reliefs. You have the exemption method, the release method. Okay. All right. Let's go ahead. Objectives of tax treaty.
A major objective of bilateral
What's the difference
bilateral
between
tax.
bilateral? Hold on. What's the difference between bilateral treaty and multilateral treaty?
Bilateral is between two countries.
Mm-hmm.
Multilateral is between a state and then foreign companies.
I didn't say multinational. Multilateral.
There are
It
two
can
or
still
more.
be between a lot of companies. But don't say a state between. That's not the only aspect. Okay. All right. Go ahead, Mark.
Yes, sir. A major objectives of bilateral tax treaties is to remove impediments to international trade and investment by reducing the threat of double taxation. Tax treaties provide certainty for taxpayers. Certainty concerning the tax consequences of cross-border investment is an important factor in facilitating such investment. Tax treaties facilitate administrative cooperation between the contracting states. This administrative cooperation has three main dimensions: exchange of information, assistance in the collection of taxes, and dispute resolution.
So please
Tax
note this,
treaties
it's
have
very important.
Yes, sir.
Exchange of information. So when I was going through it, I explained to you that the Indian Revenue Authority can ask Ghana to provide them with the list of Indians in Ghana, okay, who are working in Ghana, okay, for tax reasons. And Ghana doesn't have any other alternative brand to provide it. And by doing that, the GRA liaises with the banks, and the banks are obliged to divulge those information. Okay. All right. An assistant in the collection of taxes. The India Liberia Revenue Authority can ask Ghana to give them the list of Liberians that they can provide a list of Liberians that they know they are working in Ghana, that they should collect, GRA should collect the taxes on behalf of Liberia Revenue Authority and remit it to them. Likewise, when it comes to dispute resolution. All right, let's go ahead.
Tax treaties facilitate administrative cooperation between the contracting state. This administrative cooperation has three main dimensions: exchange of information, assistance in the collection of taxes, and dispute resolution. Tax treaties have the objective to eliminate discrimination against foreign nationals and non-residents. Treaties may remove tax impediments to desirable scientific, educational, cultural, artistic, and athletic interchanges. Tax treaties promote transfer of technology. It promotes goodwill between contracting countries and states.
All right, let me ask you this question. The coming into force of the Africa Free Continental Trade Agreement and then the relations between the multilateral countries, what benefits will Ghana derive in the Africa Free Continental Trade Agreement in relation to taxation? Go and think about it. Observe it. Let's go ahead.
All right, sir. Problems, dangers, effects of double taxation treaties.
Please, when we see advantage, disadvantage, advantage are benefits, disadvantage are problems, dangers, effects, they are the other side, is the negative side.
Okay, sir.
If you see that they said bedeviling. What are the issues bedeviling double taxation? They are the disadvantages. Because you have not heard the word BEDVILING, you are sitting down behind the paper because something buffer.
Yes, sir.
Yeah, same one. All right, go ahead.
All right. There is no credible evidence that tax treaties have significant positive effects on foreign direct investment activities. Treaty negotiation involves dealing with a broad range of complex matters. Double taxation agreement, DTA, ought to meet the political and economic interests of both parties as far as possible, and this ensures that it works smoothly in practice, and it avoids creating a strenuous relationship among relevant authorities. Unfortunately, there is a lack of clear guidelines and understanding of DTAs by policymakers. DTAs inherently pose a risk to development financing in Africa, in the sense that they skew taxing rights away from African countries, are now subject to abuse that eventually erodes the tax base. DTAs inherently, I take it again, DTAs inherently pose as a risk to development financing in Africa, in the sense that they skew taxing rights away from African countries, are now subject to abuse that eventually erodes the tax base. DTAs have also been used by foreign and local companies to pay as little tax as possible or no tax at all. Assisted by accounting and advisory firms, multinationals shift their profits from high tax to low tax
That's called the tax
jurisdiction.
haven. That's called the tax haven countries.
Tax haven, okay. While this may make sense for the bottom line, it is highly questionable and at odds with the intention of such agreements. Double taxation induces a hardship on taxpayers through an increased tax burden on the investor and can result in the increase of the price of goods and services. Discourages cross-border investment through curtailing capital movement. Double taxation may violate the tax fairness principle.
Yes, because I have to tax you, because we have a DTA with your country, the fairness, I'll look another person and tax you 20%, but because you have a DTA with your country, I cannot tax you 20% because the DTA we have signed. The president have signed it with your country, so that one we have to do 10. Maybe the DTA can even state even 8% or 5%, lower than what. So when it happened that way, it is eroding what? The tax base. Do you get it? If not the DTA, I would be getting 20% as withholding from you, which may end up being maybe 60,000. But because of the DTA, I'm not getting 60,000. I'm going to get maybe 2,000. Do you get it? Hello?
Yes, sir.
Okay. I think I have to end on realization. Promise. We're couple 9:30. Read this one.
Realization of assets. Anthony Kofi Juma, a Ghanaian resident in USA, resettled in Ghana in 2015. He purchased a house at Kotokraba in Cape Coast for 2 million Ghana cedis. In January 2022, he decided to sell the house to Kojo Atta, a businessman, for a consideration of 7.5 million. Anthony Kofi Juma incurred the following costs before selling the property: renovation of the entire house at the cost of 1 million, advertising, consultancy, and legal fees at 10% of the selling price. And then 3, Anthony Kofi Juma used 60% of the gross amount realized to acquire a new house at New Botiano in November 2022. Required. As a tax consultant, advised Anthony Kofi Juma on the following issues in relation to capital gains tax. What constitutes a chargeable asset? 5 marks. Exemptions from chargeable assets, if any.
Go ahead.
So I'm
Yes.
done.
Aye. Comment.
Okay. The procedure for filing a return. IV. The amount of tax payable by Anthony Kofi Juma.
All right. This is an realization of assets. Yes.
Yes, sir.
Let me hear your response. Feedback. Yes. How do you treat
What
it?
constitutes?
What constitutes a chargeable asset? Or what's a chargeable asset? Yes. If you are the great. If you are there. Hello.
Yeah, hi. Where are with you?
Answer the question. You are still with me. Amina.
Okay. So first of all, hello.
Yes.
So I will indicate the what they call it, the company name. This one is even an individual. So
No,
indicate
we have not reached the tax payable. We are starting from the I. Answer the question as you see it. I say 5 marks. What constitutes a chargeable asset? And I'm asking, what is a chargeable asset?
when an asset is being transferred or surrendered, then it's constituted a chargeable asset.
Okay. Sandy, you are lying. For today, I have to tell you, it's wrong.
Hey, I'm lying.
Sir. Sir. Fair.
Then you can laugh, man.
Fair your question. Hello.
Tell again.
Yeah,
Yes.
is the
Sir, can I
income of
try?
business, employment, and investment plus chargeable deduction.
Who is that?
Benjamin.
Is it the
Wait,
ladies around?
he has gone to the bush.
Is it the ladies are laughing at you? I'm not the one laughing at you. Benjamin, you are wrong. What is the chargeable?
Sure?
Yes.
Can I try?
Yes, try.
I'm not too sure, but I'm just trying. Chargeable assets. Is it an asset that you can charge a capital gains tax on.
You are using the this thing to answer it. Well, they may give you two or three or five. Other two.
So when
Okay. Is
uh,
the
when
is
an
the income
asset is being is this disposed? Huh?
Yes, if you are saying something, let me know that you are the one speaking, so that
okay, Sam, I'm coming back again.
you are coming back
Is the
again. Why? When you went, the lady sacked you from the house, and you are coming back
no, they
again.
didn't sack me. They didn't
Oh,
sack me.
okay.
Is the consideration relates from an asset less all the
Hey,
accessible
hey, hey! Benjamin, be very careful.
atasa.
If you are saying that, then what is realization of an asset? You are defining realization of an asset. What you said is realization of an asset. And there are two ways of realizing an asset.
So
Yes.
let me try to put mine in a better position.
Who are you? And you are putting in a better position. Your name.
So
Your name,
the
please.
chargeable asset,
Your name.
Gladys.
Oh,
Gladys.
Gladys. Oh, okay. Okay. Hey, Gladys. Okay, go ahead.
Yeah, the chargeable asset is an asset that you receive a gain on after it's being disposed.
After it's been disposed. So chargeable asset is only disposed. Hey, my dear. Chargeable asset is not only by disposal. There are various means.
Okay.
You can transfer, you can own it by through
So
a
you
dash from
you
your
knew you knew I was
through a
saying
bill.
the right thing, and you were telling me I'm lying.
What did you say?
Maybe how you first.
I said when the asset is being surrendered or transferred,
It
the
said what
ownership,
an
part
asset.
ownership, part ownership.
Hold on.
Eh?
Hold on. Said when an asset is being what? Surrounded
Transferred.
Yes,
or transferred.
or part. Eh?
Or part what? Finish it.
Part that's part ownership. That is in either exchange or being transferred to
So
another
example.
person.
Add the examples of it. You have not, it's incomplete. Add example.
What has a crowd?
See that?
Add example.
Okay. So
What is the
for
other
example,
person party ownership with? What asset is the other
so
person party ownership with?
Sorry?
What you said, is there an asset defined here? Which asset are you talking about? Is it an investment asset? Is it a depreciable asset? Or is it a
I'm
capital
talking
asset?
about depreciable. I'm talking about depreciable asset.
Chargeable assets are not only depreciable assets. So get to know that. Shares form under
So
shares.
instead you to encourage me, to motivate me to think more, you are telling me I'm lying, and you made others to go to bush.
Listen. You first need to
Yes.
identify the assets. Okay. Because what you said, you never mentioned any asset in it. So we don't know which asset you are mentioning. You can, this examiner can give you 0. But if you be able to mention the type of asset that form under the chargeable assets, and you say when you part ownership with such asset, then you fall within, though you are not able to state the definition perfectly. And that's where you need to know what assets forms chargeable assets. Land is form part of a chargeable asset. Investment assets like shares, they form part of chargeable assets, as well as some depreciable assets. Okay, so if you don't say that when one party parts away with another asset, for instance, a land, part with ownership as a result of being transferred to the person, as a result of it being a will, as a result of a sale. You see, somebody said disposal. I said it cannot be only disposal. I hope you get what I'm saying. Sunday.
Very well, very well.
So please.
My issue was for you to push me to complete it.
I should push you to complete it. Because I realize where you are going. If I don't take time, we will cross the river Jordan. And still we will not, we will be seeing people chasing us in our dream. So I don't want people to be chasing us in our dream. That's why. Okay. Gladys, you wanted to say
Yes,
something?
sir.
Or you wanted to ask a question?
No, sir.
So you see, Sunday, are you there? Yes.
Very well, I'm here.
I was helping you to identify that question in the Kofi Juma question. Okay. So you realize that you could realize that there was a land, isn't it? When we were doing divisible assets, we didn't treat land, we saw land. There was some 150 question. You remember that? Do you recall?
Yes.
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 Did we treat that question, that land? No, isn't it? Because that was a divisible, that was a chargeable asset. Okay. And chargeable assets, you realize gain. You could realize, you could remember, what do you call it? Benjamin was even defining realization of an asset. So under chargeable assets, we realize those assets. Okay, Benjamin, how does realization of assets occurs? When do we say an asset is realized? There are 3 conditions. There are 2 conditions, yes. Yes, when do we say an asset is realized?
When it is being sold.
Who is that?
Or disposed.
Hey. When it's being sold and what happened? Sandy, are you the one saying this?
Sorry?
Sandy, are you the one? Hello? When is an asset realized?
When the risk of ownership is being transferred.
Yes, the risk of ownership is transferred, but there is something. Okay, when is a realization of when would we say there is a gain on realization of an asset? Let me put it that way. When do we say that there is a realization of an asset?
When the consideration is higher, is more than the cost
When
of
the
the asset.
is more than the cost of the asset. And then another way around, there are 2 ways, please. That's not the only aspect. That's in the case of an asset. What about in the case of a liability? In the case of asset, there are 2 forms. Hey, forgotten. Benjamin, are you there? Hello?
Hi.
Benjamin. Yes, I'm asking all of you. Please, answer the question. When do we say an asset is realized? When do we say that there's a capital, we say there's a capital gain on the realization of an asset. There are 2 forms. It occurs in 2 forms. In the case of an asset and then in the case of a liability.
When the outstanding liability is not claimable.
No, you made a mistake. It's not that it's not claimable.
Or it's either.
It's not true. When the outstanding liability, when the outstanding liability is less than what?
The asset.
It's less than the what?
The asset.
The liability is the total liability.
The total liability, thank you.
Okay.
Yes.
Let me explain to you. Let me use a scenario explain to you. Please, can you see my screen?
Yes, please.
Yeah,
Yes,
we
sir.
can see it.
Okay. So let me explain to you. Okay. You see, under the realization of asset, there are two ways. One, you see, Gladys and IKEA. Gladys have an asset, okay? That is a depreciable asset or a chargeable asset like a land. Gladys, it cost Gladys 500,000 to buy the land. Gladys sold the land to IKEA at 800,000. Okay, after doing all documentaries, what do you call it, land valuation, and going to the land commission to do all the registrations and other things. So it bought it 500,000 and sold it to IKEA at 800,000. At that place, the money that Gladys received from IKEA is known as the consideration received. I hope that you get it.
Yes, please.
When you did contract under Curie versus Misa, we say consideration, okay, is said to be a right, a benefit derived by one party, the promisor, okay, or a detriment suffered by the other party, that is the promisee, for a sum of consideration. And consideration, we say that it is the amount, the benefit you derive, okay, from getting that asset. So in a contract, when you have an agreement and some funds have not moved, we don't say that there's a consideration. Until consideration is received, we see there's a contract. So consideration is the amount that it paid, the 800 it paid, okay? And then the cost is 500. So you see that when the consideration exceeds the cost, there is a what? A gain on what? Realization, capital gain. Okay, there's a gain on realization. Please, is it clear to you? And now the law will repeal that whatever consideration you receive, okay, it is subject to a withholding tax. If you're a resident person, it's subject to a withholding tax rate of 3%. If you're a resident person, consideration received if you're a resident person is subject to 3% tax rate. Okay. With the consideration received, we subject to 3% tax. If you're a non-resident person, consideration that you receive from any assets, investment, other investment asset, capital asset, or chargeable asset, the consideration received will be subject to 10% what? Withholding tax. Now, in the case of that, I have explained the assets. In the case of a liability, okay, Gladys sold the land 800 to IKEA. Gladys bought the land 500. Now, when Gladys was going for the 800, IKEA gave Gladys 600 and said, I'll give you the 200 in the next month. Do you get it? Now, at a point after the 2 months when Gladys went back, IKEA had an accident and the IKEA situation is very worse to the extent that the way Gladys saw it, she decided to write it off. She decided not to claim it again. Do you get it? That debt, that outstanding liability, which Gladys decided not to claim from IKEA, okay, is a benefit to IKEA, it's a gain. And that money is subject to what? We call it a capital gain. It's a liability, capital gain in relation to liability. So that is also taxable. Please, I hope you get the illustration clear.
Very well.
Yeah.
This is how they say it. Very well, very well, very well. When they go and they will go and be writing differently. Very well, very well. Okay.
Go there, it will be fine.
Exemption from chargeable, the exemptions from chargeable assets. One, when your father or your mother directly, okay, give you an asset as a result of a will, a gift, that asset is not subject to capital gain tax. Okay? That is exemption. Another one is that when a couple divorce, okay, and there is a share of the property, the part of the divorce property or title, it's a claim what given to it. That asset that they share, though it becomes a gain to either of the party, okay, it is not subject to capital gain tax. Please, I hope that is clear.
Yes, sir. Yes, sir.
If a company buy a stock that is listed on Ghana Stock Exchange, and they make
It
a
is
gain
exempted, yes.
on that stock investment listed on the Ghana Stock Exchange, it's also exempt from tax. I leave the two for you. Go ahead and think about it. Filing of it, we look at it. All right, let's look at the question. So you realize that Kofi Juma, he bought the land, which year? He purchased a house, isn't it? What was the cost of the house?
2 million.
2 million.
And what was the consideration he received from the house?
7.5 million.
7.5.
But the question says that before he sold the house, he incurred some expenses on the property, isn't it?
Exactly.
He renovates the property, which costs 1 million. That is called an
1
incidental
million.
cost. Okay. He also did some advertisement and consultancy and legal fee, which was 10% of the 7 million. 10% of the 7.5 million will give us what? 750,000, isn't it?
Yes.
Then they say Kofi Juma used 60% of the amount that he realized to acquire new assets. So that is what we call realization with a replacement asset. And when it happened that way, there is something we call rollover relief. All right, let's go. So look at the solutions. Computation of capital gain tax. Kofi Juma, computation of capital gain tax. The consideration received was 7.5, isn't it? Then we less the cost base. The cost base comprises of the initial cost of the asset, which was the 2 million. There was a renovation, which cost 1 million. And then we did consultancy and legal fee, which was 10, and selling fee, which was 10% of the 7.5, which is 750. When you add it, that's from the cost base. You less it from it, you get a gain of 3,750,000. But because he used 60% to acquire a new asset, there is something we call rollover relief. So we less the rollover relief because it's called using realization of assets with a replacement asset, because he sold a building and then he bought another building. And if it's happened when it happened within the 6 months, okay, it's exempted. All right. So if 60% of the 7.5 million to acquire new asset, that's the 4.5 million. Now, under the rollover rule, because you have used it to acquire assets, you less the cost base from the cost of what you used to acquire the assets. And that will become 750. And that reduces its chargeable income. Now, this is also another way of tax avoidance strategy. Okay. So you can use that in the case of buying, in the case of paying, if he has not used the assets, the fund, the realization, the amount, the consideration received to acquire a new asset, we would have paid tax on the 3,750,000. But because he used part of the money to acquire a new asset, he has gotten a relief of 750, which has reduced the chargeable income from 3,750,000 to 3 million. So now he paid the tax, capital gain tax of 15% of the 3 million, that's 450. Otherwise, calculate 15% of the 3,750,000, what do you get? Hello? Well, I think the mission we stand up setting. I have to get ready to close. Hello.
Yeah,
Hi,
hello.
sir.
I asked a simple question. Nobody is talking, so I will end the class.
Oh, no.
Sir, we are here.
Yes, that.
Adeɛ no so yɛ free so na mo check mo akyerɛ me. Adeɛ. Calculate 15% of 3,750,000. Nobody could give me the answer.
There is 562,500.
Thank you, my dear. God bless you, okay?
You're
You
welcome.
learn hard, okay?
Amen.
For responding to my answer. The rest, I leave them to their books. All right, 5,620,000. If he has not used the proceeds to acquire another asset, he would have paid 5,562,500 Ghana cedis as what? A tax. But because he has gotten to know of realization of asset with a replacement asset, okay, he got a rollover relief and is paying a tax of what? 450,000. What is the tax savings? That'll be 112,500, isn't it? Please, do you get the explanation here?
So please come again.
Hey, Sabra for no man can be. Who is that? Is it Gladys or Okia?
Please come again. The network was.
Never say that word again. Abba come you. Please use the correct English.
So please go over.
Thank you. So we go back to the question. It's an realization of assets. Kofi Juma, he received 7.5, isn't it? That's the consideration, and the cost was 2 million. In care renovation, okay. But the II says that Anthony Kofi Juma used 60% of the gross amount. The gross amount is the 7.5. Gross amount is the accessible income. Accessible income is the gross amount which have not been subject to any deduction. The amount that has been subject to any deduction is the chargeable income. Please, is that clear to you?
Please.
So Kofi Juma used 60% of the gross income realized to acquire a new house at New Botiano. The first house that he purchased was at Kotokoba in Cape Coast. He sold it. And then he used the money to come to Accra to buy another house. And it was in which November 2022, isn't it? When did he sell the house?
Same year.
Which year, when did he sell the house? You say
January 2022.
2022.
January 2022.
Can you laugh? And when did he acquire another asset?
In November 2022.
Oh, it was within a year.
Yeah.
You get it? So he gets a rollover relief. But if you wait after a year before acquiring, you will not benefit from the rollover reliefs. And I'm saying that you can state this also as part of what? A tax avoidance strategy. Do you get it?
Okay.
Yeah. As you are learning on different topics, you learn unless you are not putting your brains into calculation. All right. So you can get a rollover relief from that aspect. So this is why we are saying that the consideration was 7.5 million, isn't it? Now, let's the cost base. The cost base comprises of the initial cost of the asset and any incidental cost. When you say incidental cost, things that you did to enhance the asset before you were able to sell it. If you are driving a car and after a certain point you want to sell the car, you definitely will go and change the plugs and other things and turn it to mechanic can spray and let it be in good shape, then it will look attractive and people will buy. So those are incidental costs you incur. And then if you are looking at an agent who has to get you somebody to buy, you also go on a percentage aspect. So that was a consultancy cost. That was 3,750,000. When you less it from the consideration, the chargeable income will be 3,750,000. But because he was able to use 60% of the asset to buy another asset within 1 year, he qualifies for what we call rollover relief. So we are going to less the rollover relief from the chargeable income. So first, we bring the cost of the replacement asset. It was 60% of the 7.5 million. That's going to be 4.5. Now, the cost base we calculated here was 3,750,000. So you less the cost base from it. When less the cost base for it, get a rollover relief of 750,000. And you less this 750,000, that's what the rollover relief is, 750. You less it from the chargeable income. And then you get the chargeable income of 3 million, on which you calculate the capital gain tax on. And capital gain tax is 50%. Okay, for companies is 25%. This is an individual. So, and that's why I'm saying that if you have not used the asset to acquire a replacement asset, you would have ended up paying 15% of 3,750,000, which it was 562,500. But because he has been able to get a replacement asset, he has made a cost saving in terms of the tax that he was supposed to pay. If you haven't bought it, I've paid traffic. So I've made 112,500 as a tax savings. Please, is that clear to you? The person who said I should repeat it. Hello? This is the reason. Then I'll end it. That's all. I finished. If I don't get a feedback.
Either Gladys or Appear.
Yeah, I'm fine.
Mark, read this last
Hello,
question.
sir.
Conclude.
Okay, sir.
Question.
You can't ask me a question.
Realization.
You cannot ask me a question. When I asked you, did you get it? You didn't explain. You didn't say anything. Please don't come. Don't bring yourself for me to get angry with you. When I was asking you, did you get it? Did you respond?
Oh,
For me
sir.
to know
Sorry,
that
sorry.
what I was communicating has gotten to the recipient. You never responded. Then you come with a question.
Sorry. I think I had muted. I didn't know. Sorry.
Wait, is it Mark? Mark, were you the one said you have muted?
Yes, sir.
It wasn't you. I heard a lady saying a
Okay.
question. It wasn't you. It isn't you. Okay. She was the same person who asked the question. I heard a voice. And I'm asking you, are you clear with what I explained? You didn't say anything. You didn't mind me. Now I'm moving to another. You are telling me a question.
Sorry,
we
how?
were told. Sorry.
Say it again.
I'm sorry, but we
There's
were
one lady
told.
called. Okay.
Andy,
And then
keep
another
mute.
colleague.
Andy, keep
So I
mute.
thought you were.
You said what?
So it was I and one colleague. So I thought you were referring to the other colleague. That's why I kept mute. I'm sorry.
But if it's two of you, did you benefit from what I explained? Yes or no?
Yes, please. Yes, I did.
So what stopped you from coming up? Expecting the other colleague. When you're going to example, are you going to write the same thing that he's going to write?
No, sir.
Is your index number the same as his index number?
No,
So
sir.
please bend your light individually. Okay. Let me give you the benefit of the doubt. Ask your question.
So please, in case there was no rollover relief, will we have ended the calculation at the consideration at the 3,750 and just calculate the 15% on it?
Somebody should answer this question for me. Are you Gladys?
Yes, please.
Ikuya, are you there? Okay, somebody should answer him for me. Should answer here for me.
Yeah, yes, we would have ended it there. Then apply the tax rate on it.
Is it clear to you?
Yes, sir.
All right.
Thank you.
Welcome. Mark, read. I think this.
All right, sir. Realization of asset.
Mike, hold on. I wanted to reduce it a bit. Go ahead. Mike, read.
Okay. All right, sir. So, realization of asset. Commerce Ghana Limited is a financial service limited with its registered office located in Roman Region, Accra. The basis period of the company ends on 31st January of every year. In August 2017, the company acquired a parcel of land at Oduman at a cost of 90,000. The company spent 10,000 to complete the title registration process at the Lands Commission. In February 2018, the company purchased shares in Universal Merchant Bank UMB Limited for 50,000 cedis. In April 2020, the board resolved that the company should sell the parcel of land and the shares for 450,000 and 150,000 respectively before the end of the current basis period. The board also resolved that the company should acquire a parcel of land in East Legon Hills and shares in please, I take it again. The board also resolved that the company should acquire a parcel of land in East Legon Hills and shares in Consolidated Bank Ghana Limited in March 2021. And shares in Consolidated Bank Ghana Limited in March 2021 required. Calculate the capital gain. Then B, discuss the income tax implication of the realization of assets.
So, under this one, how do we treat it? First, you have to
Hello.
identify both assets. Yes.
You go ahead.
What assets are in this question?
Yeah, we have two assets. We have the land and then the shares.
And where will you classify them as?
The land will be a chargeable asset. And then the
Hey, you
shares
said
will
the
be
land
an
is a chargeable
investment.
asset. Yeah, chargeable asset. Okay, go ahead. I thought you said depreciable. Chargeable asset. Yes, go ahead.
Chargeable asset. And then the shares will be under investment.
That's good.
Investment asset.
Thank you. Thank you. Thank you. So the land, what was the cost of the land?
90,000.
And they spent 10,000, isn't it? Additional
Yes,
cost.
please.
And how much did they sell the land?
450.
What was the consideration? Yes. So
450 Ghana.
Consideration received
150,000.
and the land and the total land, the land was initial cost was 90, and then the incidental cost was 10,000. Add to it, what will be the total cost?
100,000.
So you less than 100,000. That's the cost base from the consideration of 450. What will be the capital gain?
350,000.
So what will be the treatment of the 350,000?
The tax rate will be 25%. But it's not individuals, it's companies.
Fine, but you have to add it. If there is any chargeable income, you have to add it back to the business income.
Okay.
Under Section 5 of the Income Act, 896. In relation to the shares, how much did the company buy the shares from Universal Merchant Bank?
50,000.
And how much did they sell it for? Were they able to sell at the bank? Oh, so what was the gain over there?
100,000.
So that 100,000 under investment assets will fall under. We also add it to the chargeable income and tax at the graduated the corporate tax rate that he said. Okay, 25%. To add back to the business income, unless there is zero business income before we can at the corporate tax rate. And then the investment income fall under Section 6 of the Income Act, Act 896. All right.
Okay, so we treat it differently, like the calculation.
Yes. Okay, the solutions are here. Okay.
Okay.
All right. 150, 50, 100. Okay, let's go to this question. I think, Mami Yahweh. Mr. Reader. Today,
Yes, sir.
Today, you are devoting
Merger,
yourself.
acquisition, and amalgamation. Rockfield Limited is a non-resident company based in USA. Rockfield Limited has succeeded over the years acquiring and selling companies in distress alongside its primary objectives of buying and selling cosmetics.
Are you using two phones? Are you using two gadgets?
Yes, sir.
Are you using two gadgets?
Yes, my phone and the laptop.
Please mute one.
Yes, please.
Go.
Sorry.
Lower one. Because one is too big. Okay. Go ahead. Start.
Okay. Rockfield Limited is a non-resident company. Please, is it okay, sir?
Yes, it's okay.
All right. Sorry. Rockfield Limited is a non-resident company based in USA. Rockfield Limited has succeeded over the years acquiring and selling companies in distress alongside its primary objectives of buying and selling cosmetics. In the 2022 year of assessment, it decided to announce its presence in Ghana by acquiring Nordia Capital Limited, a resident company. Nordia Capital Limited has had financial setbacks in its fortunes over the last couple of years and became vulnerable to predators. Required, advise the management of Rockfield Limited what the tax implications are if Rockfield Limited acquires more than 50% of the underlying ownership of Nordia Capital Limited.
Yes. Let's start. What's the answer? Let's go. And the measures acquisition and amalgamation, yes.
Yeah, so if the underlying ownership is more than 50%, then it will amount to change of ownership, where the new company, the time of I have to organize myself and come back. I'll have to come back.
Yes.
Okay, hello.
Okay. Under
Okay.
Section 6, under the Section 62 of the Income
Is that Benjamin?
Tax Act.
Is that
Yes,
Benjamin?
please.
Oh, okay.
Yes, please.
All right, go ahead.
Under the Section 62 of the Income Tax Act, if a company acquire more than 50% of the underlying ownership of other company, it's the profit that it made will be exempted from tax. But when it is below 50%, it will be subject to tax.
Okay. So the profit realized, yes. And then in relation to that, what are some of the tax implications? Between the new owner and then the acquirer and the acquiree. Hey, you have forgotten Benjamin. Sunday, where's Stella? If Stella is here, I would like Stella. Stella will be giving me to eat, blah, 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 blah. But I'm happy you mentioned Section 62 of the Income Tax, which means, Charlie, you did for.
Sir.
Yes.
Please, if you don't know the the section that you mentioned, Section 62, if you don't know to quote, how will you raise your answer. Like,
You can paraphrase it.
would they mark you wrong if you
No,
started,
no,
if
no,
the
no, no,
company
no, no.
acquired
No,
50
no, no,
without
no,
quoting the act?
no, no, no. When he quotes the art, okay, and you got 75 and you also got 75, okay, and
Yes,
they
please.
will go through the second cross-checking. Somebody will
Yeah.
make references to the art, eh, will
Yes.
be given maybe +2 or +3 to take that award.
Okay. Okay. Oh, all right.
Do you get
Thank
it?
you. Yes, please. Thank you.
Because he quotes it verbatim. So if it's 5/5, they can give you 5/5, but you may be given 4
Okay.
or
Okay.
3.
Mm.
All right. Yes. What happened between the new owners and then the old owners?
So, sir, please, can I come in now?
Yeah,
So,
come.
the new owner is this will be deemed realized.
Yes, it will
So
be
in that
realized.
case,
Is the word.
the new company cannot deduct financial cost, cannot deduct, cannot claim
Claim.
refund, cannot deduct
Cannot claim financial cost under section what?
the section. Say,
All right, go ahead. You go ahead. You go ahead. Go ahead.
so
Yeah.
cannot claim.
Mm.
What did I even say? Cannot claim refund or it cannot deduct unrelieved losses.
Bad debts.
It can carry forward losses.
Yeah.
And then bad debt.
Okay.
You can't deduct bad debt too.
But that's the new owner or the old owner?
The new owner.
The new owner. But what can the new owner enjoy?
The new owner.
We did something under lessor lessee. You can even use that too.
Sir, please, someone should help me.
Yes. Who is helping him? Ikea.
Sandy.
Ikea, are you there?
Yes, I'm here.
Oh, okay, I help my people. Gladys. Hey, Dana. What? Dana and Amina. Speak now. Yes, Gladys.
So this one there, I don't know.
Why? Yesterday, did you give your prediction? Your confidence level? Or yesterday, did you join?
No, please, I didn't join.
All right. The new owner, we did lessor lessee and a finance lease. So the new owner will enjoy capital allowance of the what? Of the assets that he has taken. And during that time, they are supposed to file 2 separate tax return. They'll file one which will be before the new change, before the change. And then they'll file one after the change. So if the change happened within a year, okay, and these people are separated for 6 months before there was a change in underlying ownership, they'll file their tax return for the first 6 months, showing before the change, and then the last 6 months after the change. Let's assume that they operated for 7 months or 8 months or 9 months before the fiscal year end 12 months. So they operated for 9 months before the change, and the change started from the 10th month to the 12th month. So from the first 9 months, the income that they get, they will file their tax, okay? And then for the remaining 4 months, 9 months, the remaining, that would 9 plus, what would make it 12? The remaining 3 months, okay, they also file a tax return separately. All right, let's go back. So, Mr. Reader, read.
All right, sir. Mergers and acquisitions have blessings for the predators and may equally bring losses to the predator. Therefore, under Section 62 of Act 896, Act 2, 2015, the following shall not be benefited by the new owners: that are in Rockfield Limited in this. The financial costs incurred under Section 16 cannot be beneficial to the new owners. The acquirer, new owner, shall not benefit from any loss incurred under Section 17. Okay. The acquirer shall not claim any bad debts incurred by previous managers. The new
Under
owner
Section
shall not
23.
carry back. Hello, sir.
Bad debt is under Section 23.
Yes, please. I've seen it. The new owner shall not carry back loss if it is in a long-term contract. The new owner shall file 2 tax returns, one before and one after the change in the underlying ownership. The acquirer will benefit from new values of depreciable assets. The acquirer can rebrand to create a value-added image for the entity.
I hope that is clear.
Yes, please. I'll add it to my diary.
Let's go to this question. Read.
Yes, sir. Merger, acquisition, and amalgamation. There has been a merger among 3 companies, AN Limited, BAB Limited, and C Limited. The merger was geared towards creating a monopoly in the market. After careful reevaluation of the assets and liabilities of the companies, the following is the outlook. Gain from realization, AN Limited 4.2 million, BAB Limited 5 million, C Limited 5.2 million. Market value 9.2 million, stated capital 5 million. The following is the outlook of the new company after the merger. Profit 5 million. Required. As an intern of ICAG and Associates, write a memo to your partner on the company's tax exposure after the merger.
Yes.
Wow.
Hello.
Hi, sir.
Let's go.
I'm analyzing it, sir.
Then I am cool. You see, if to realize the gain, gain is the market value less the stated capital. Market value, if they give you a financial statement, look out for the market value. Look out for the stated capital. Sometimes they may give you the market valuation. Okay.
Okay.
So those of you have done some little knowledge in stock and shares. Yes, somebody was saying something. So over here, you see, you rather see whether it will pay tax on their profit or not. All right. So let's go. The exposure. It was a memo, isn't it? So memo is 2, and then from. My guy, read.
Yes, sir.
You still have your other.
Yeah, I forgot.
I'll be ending in a short moment, so that's.
Yes, sir, sorry. I think the body is getting tired, so the mind is. To partner. Okay, so memo to partner. From tax intern. Date 16 February 2021. Subject tax exposure after the merger. Introduction. Following our discussion on the above subject matter, I finish as follows for your consideration. Issues. The gains on the realization of an asset accruing to or derived by a company arising out of a merger, amalgamation, or reorganization of the company are exempt from tax when it is a continuity of at least 50% of the underlying ownership in the asset, Section 62 of the Income Tax Act 896. Tax implication. The merger of the three and gains arising from the mergers shall be pitted against the underlying ownership in the new entity. Any entity that is less than 50%, the gain stands to be taxed at the corporate rate that the entity is exposed to. Unlimited 4.2 BAP 5 C 5.2. From the above gains, the company in the post-merger, if the underlying ownership in the post-merger is less than 50%, shall be subject to tax at the marginal tax rate of 25%. The reverse is exempt from tax. The profit being made is a testimony of the positive of the merger and therefore subject to tax in the marginal tax rate. Conclusion. I hope the above would help you in your further action on the matter. Thank you. Yours faithfully, Edith Abebio.
All right. Like Benjamin explained, when the underlying ownership is less than 50%, you are subject to tax. So when they tell you that it owns an ordinary share of this, and then this share, like you calculate the shareholding, you compute whether it is 50%. If it's not up to 50% and it's 49.9%, it should go and pay tax. Should 50% or more. So it is equal to, greater than or equal to 50%. Okay, which means it should be 50% or more. That is where it is exempt from tax. All right. Last question, then I'll close.
Yes, sir. Okumu Oil Palm Company PLC has been into tree cropping for some time now. The last 4 years has been a boom for the business as its fruits are bought before they are harvested on the farmland. Okumu Oil Palm PLC intends to transfer the entity to Presco PLC as a going concern. Explain the tax implication of the transfer of Okumu Oil Palm PLC to Presco PLC.
I know you will not be there, so let's go. Where the solutions?
When there is a change in underlying ownership, the following will arise. The assets and liabilities are deemed realized. The period before the change and period after the change shall be treated as separate years of assessment. The entity that changes ownership shall not deduct the financial cost from derivatives, loss incurred before the change of ownership is not allowable. Bad debts cannot be claimed. Carryback of loss cannot be benefited by the entity, shall be subject to tax on the gains made.
So that is the new entity. All right.
The new entity, yes. Withholding taxes, okay, that's fine.
Let me leave that aspect.
Right.
My people, the emission return are certain, isn't it? Hello.
Yes, sir.
Hi.
Hey.
Yes, sir.
Have you benefited from what you have done?
It has been phenomenal.
That's good.
Or I was boring?
No, it was okay.
No,
Say it again.
So it wasn't boring.
It was very boring.
It wasn't boring.
Yeah. Will you put the knowledge you have acquired into practice?
Very well said.
And you write the exam successfully? Please, my last word for you. Let me give you areas to go and learn. Aside what we have learned, try to go through VAT. Okay. Go through mining and petroleum operation. Okay. Hey, transfer pricing. Shit. Well, let's see what best could do. Maybe when I share this and you get that. All right. So master all what you need to do, and then go to the exam and attempt the question with speed and accuracy. Don't be in a hurry to be writing short answers, like the way you are answering questions here. Okay. Give the full answer. If you can't give the full answer, that was when I was explaining, I use illustrations. so that you will not forget. Do you get it?
Yes, please.
Yes, sir.
So please remember some of the illustrations. Some of the things is pop your mind. If you can recall in an illustration, give the illustration to suit that. For all you know, you only need that mass to cross over. Now, there is
Okay,
this
sir.
question that came this week. What 3 policy will you advise the current government and the Commissioner General to use to widen the tax brackets or the tax net to get the informal sector taxed? What policy approaches will you advise the government and the Commissioner General to use to tax the informal sector in order to open the tax brackets? Because artisans and people and other things are not paying tax. People selling by roadside are not paying tax. What 3 approach would you advise? So in your leisure time, try and see if you can solve it. May the Lord mighty be with you, and may He give you the grace and wisdom.
Amen.
And may
Amen.
you go to the exams with confidence. Okay.
Amen, sir.
And don't go with fear. Yeah, it's good when you qualify, the happiness and the joy that it comes with. So
Okay.
those of you, yesterday I gave my number out of Twitter school. So if you have anything, I'm on the platform. I may likely put some questions there for you to try also, if I get it there. But from now up to next week, please put in all your best. Those of you who have to take leave, take your leave, okay, and make it wisely. It will surprise you that around this time that you will be feeling sleepy more than days that you don't want to sleep. So take the advantage and be able to show the time. Thank you for your time. And all
Hello,
those
sir.
yes.
Sir, this one, sorry, if I can ask this question, when we were solving the valorization of assets, I think the second question concerning the Commerce Ghana Limited.
Yeah.
If you can check it for me, the Commerce Ghana Limited. When we were solving for the impact, which it says calculate the capital gain. You were saying that we should add the 10,000 to.
Yes, that's an incidental cost.
Okay.
Before you sell a land, you must have the document, isn't it?
Yes, we say.
So he did a processing of the land title with the land commission. So that will be part of your cost. That's what we call incidental cost. Exactly to you.
Okay, sir.
So you have a car and you want to sell your car. If the car is not in good shape, and the, what do you call it? The lamps are not working well. Do you think somebody will come and buy it? If the person takes it on the test drive and he's hearing noise, cluck, cluck. So you have to change the links and other things, isn't it?
Yes,
you send it to a washing bay for them to wash it, to clean inside. They do steam washing for the engine so that it look neat when the person wants to look into the engine. All those money you incurred before you sell the car, it's an incidental cost. It becomes part of the cost based of the assets.
Okay, sir. So here, before we get the gain, we should add the 10,000 to the 90,000. So that one we will get 1,000.
We get what?
Then I'm saying that we will add the 10,000 to the 90,000.
Mm-hmm.
Then we get 100,000.
Mm-hmm.
Then said then the 150 the 450,000 one. How are we going to treat it with the shares?
How much did it cost? The 450 wasn't for the shares. It's 150 that was the shares. The 450 was for the land.
Oh, okay, sir. Okay, sir. So the 150 we shall also add it to the 100,000.
No, it is treated differently. I think
Oh, okay,
last
sir.
time somebody asked, if you asked that question.
So that was where I was not getting it. So like I wanted to maybe to know the difference, like because we use the shares amount. Then we also
So when we started, I asked what type of assets were it, and people identified that there is a chargeable asset and was investment assets. So we have to treat them separately.
okay, sir.
But the shares, it has only a cost base. You didn't have any incidental cost. Okay.
Yes, we sir. Okay, sir. So it means the shares, which is that one is a 450 minus what?
What was the cost? The shares is not 450. Please, the question, the shares was sold at 150. It was the land that was sold at 450.
Oh, okay. I have seen it. Okay.
And we less the 100,000 from the 450 to get the 350.
Okay.
That it will be added to the chargeable income under the business income. And
Okay,
section
sir.
talks about the business income. Section 6 talks about the investment income.
Okay, sir. Okay.
You are clear?
Yes, please, sir. Thank you.
Okay. All right. All those who are in favor of my ending, say aye.
Sorry, meeting again.
All those who are in favor of me ending the class, say aye.
No.
Aye, sir.
The ayes have it. That's how I end my class. Today to end at 10. So thank you. There is no meeting
Bless
again.
you, bless you, bless you.
God bless you. Tomorrow.
Thank you very
Tomorrow there is no
much.
meeting. Go and learn on your own.
Okay.
Good night.
God bless you.
Sir,
Good night,
sir,
Daddy.
sir,
What is it?
sir. Yeah, please, are you going to post this notes on the platform?
Yes.
Okay, thank you.
Benjamin. Yes.
Yes, sir. Yes, sir.
All right.
Huh?